Next question. The market received a rumor about ABC Corporation's tie-up with a multinational company. This has induced the market price to move up. If the rumor is false, ABC Corporation stock price will probably fall dramatically. To protect this, an investor bought call option and put option. He purchased 3 months call option with a strike price of 42 at 2 rupees of the premium and paid rupee 1 per share premium for a 3-month put option with the exercise price of 40. Determine investors ending position, that is position if the tie-up offer bids the price of ABC Corporation to go up to 43 and if it is falling down say to rupees 36. Try to do answer of the question on your own. Let us see now again on, that is the column number 1 is the spot price of equity share, wherein we have been provided with the two prices. One is 43 and another is 36. So this is 43 and this is 36. We are call option holder, we are put option holder. So exercise question mark payoff. Exercise question mark payoff. Next is the premium, and with that so the profit or loss. This is the way we are required to do working. We have been provided with the information that we have purchased call option with the strike price of 42. Okay. So as far as the exercise price is concerned, it is 40. When the spot is exceeding exercise, you will exercise your call option. When spot is not exceeding exercise, then in that case you will not exercise your call option. If you exercise, you receive the payoff, otherwise you will not receive payoff. The put option is also purchased, and for that so the exercise price is 40. So again, whether you will exercise or not, that is a question. We understand that so the exercise price is 40, it is not exceeding the spot price 43. So you will not exercise your put option. 40 is exceeding 36. So you will exercise your put option. So you will receive the payoff of 4 rupees. The premium is required to be paid 2 and 1. That comes to 3 rupees. So it is 2 plus 1, that comes to 3. So 3 rupees is the premium and 3 rupees is the premium. So 1 plus 0 is 1 minus 3 is equal to 2. 0 plus 4 is 4, 4 minus 3 is equal to 1. This is the way we will have the profit or loss for both the cases. The exchange rate for the sterling is currently $1.50 per pound. Spot exchange rate is given. Suppose you need to purchase pound at the year end. Let us assume that the today's date is 1st of January and at the end of the year, say you want to purchase, say UK pound. You want to be sure that regardless of the future market price, you will not pay more than $1.60 per pound. So you do not want your purchase price to be exceeding $1.60 per pound. In return, you are prepared to guarantee a minimum price of $1.40 per pound. And at the same time, say you want to have the minimum cost of $1.40 per pound. What option positions would provide you with this ceiling? Ceiling is what we understand is the maximum price. And floor is indicating the minimum price. So what option positions will bring you, say this ceiling and floor, that is a question. Go through the question every one of you and try to give answer to me. So over here friends, the question is providing the information like this, that let us say that the today's date is 1st of January, and at the end of the year 31st of December we want to purchase UK pound. The question is providing the information that the price to purchase the pound should be more than equal to 1.40 and less than equal to 1.60. So what kind of the option position will bring you this kind of situation? That is a question. In order to have the maximum cost, what will you do? You will purchase call with exercise price $1.6 and you will sell put option with exercise price $1.40. There are two transactions in which you will enter upon. One is to buy the call. Why? Because you want to have the maximum cost not exceeding 1.6, and you will sell put to have the minimum cost of 1.40. Now I am giving you in detail explanation that say entering into these transactions will have the cost of the pound in this range. That is what now I am giving explanation to you. See, in column number 1 I am taking the spot exchange rate. We understand that let us say at the end of the year the spot exchange rate is 1.10, 1.40, 1.50, 1.60, 1.90. So what I have done, I have taken one exchange rate as 1.40, that is the price at which we have sold put option. Another 1.60, the price at which we have purchased the call option, and taking a price in between both of them. Then a price which is lower than 1.4 and a price which is higher than 1.6. So the entire range will be covered for the options, that is say for any of the spot price. And then we will make the computation that what is the cost of purchasing UK pound at the end of the year for individual spot price, that is individual the spot exchange rate of dollar per pound. Now we understand that say we are call option holder at exercise price 1.60. So at 1.60 I am indifferent. Below than that I will not exercise. If at all the spot exchange rate is exceeding 1.60, I will exercise my call option. So I will purchase the pound at what rate? 1.60. You think about any spot exchange rate which is exceeding 1.60. For any spot exchange rate exceeding 1.60, cost of purchasing the pound will be $1.60. So the price of purchasing UK pound is 1.60 over here. Now I am put option seller at exercise price 1.40. So the person to whom I have sold option, he will be indifferent if the spot exchange rate is equal to the exercise price 1.40. Above than that he will not exercise. Below than that say he will exercise. So whether he will exercise or not, yes, if it is lower than 1.40 he will exercise. So he will come to me and he will sell UK pound to me. So I will again buy the pound What is the price at which it will be purchased? 1.4. So you think about any exchange rate which is below 1.40, the purchase price of the UK pound will be 1.40. Now, if at all the exchange rate is falling between this two, 1.4, 1.5, 1.6. That is, you think about the any exchange rate between this. What happens at say the options are not being exercised or you are indifferent. So what will you do? Purchase from spot market. What is the price at which you will purchase it? At the spot price. So here we understand that say you will purchase at 1.40, you will purchase at 1.50, you will purchase at 1.60. So for these three spot price will purchase at the spot rate. So the price at which you will buy is 1.4, 1.5 and 1.6. This is what we understand. So we understand that say for the different spot exchange rate we will be having so the cost of the purchasing pound like this. This is what we understand. From examination point of view, writing this much answer is only sufficient. Of course, I am going to dictate a small note to you along with that, and say this table is not required. This is only for understanding purpose. So I am dictating answer to you now. In this question, comma, pound is required to be purchased at the end of year. Full stop. To purchase pound, comma, cost should fall in following range. Cost should be greater than equal to 1.40 and less than equal to 1.60 dollar. So for purchasing of the pound, this is the range. In order to keep the price in above range, comma, enter in following transactions. So friends, first of all I have explained you, that is say I have dictated to you explanation of the question and then answer. The transactions will be like this. 1, purchase call option, comma, with exercise price 1.60 per pound. Second, sale put option with exercise price $1.40 per pound. With paragraph write down, if spot exchange rate is less than equal to $1.40 per pound, comma, then cost will be $1.40, full stop. Put option sold will be exercised at the rate of $1.40 per pound. With paragraph write down, if spot exchange rate is more than $1.60 per pound, comma, then call option is exercised and cost will be limited to $1.60 per pound, full stop. If spot exchange rate is in between $1.4 and $1.6, comma, then buy pound from spot market and cost of pound will be equal to spot exchange rate, full stop. You may write this table, you may not write as you want. Writing this table is voluntary.